Good evening, traders. Well, you guys know that I don't typically bring a midweek update unless I think something is on the horizon. Of course, tomorrow, you guys all know CPI data comes out, and I do believe that we are going to see some significant price action here and some movement on the charts here soon. So one of the things I wanted to do is detail you on, of course, those of you who are following me on my website that just came up, some of the posts that I've been making. I've been getting a little bit more noisy lately. I've been indicating that there is a lot of deflationary data, and I also wanted to show our charts here and tell you what I think is on the horizon. Not only am I under the persuasion now that the market could double top, but I'm also showing lots of deflationary data, which indicates there could be a recession or worse in the future. So how can I say those two same things in the same segment, in the same video? That's what I want to get into today. First of all, one quick item of housekeeping, I guess. It's all these alerts that you guys are getting via email. I apologize. Those of you who don't have the Substack app are, unfortunately, your only choice of getting notifications is via email at the moment until the Substack developers have fully and confidently developed an application for the Android platform, which they don't have yet. So those of you with iPhones, of course, you can download the Substack app and get push notifications via the app, which is a little less intrusive than having an email alert come in every time. But I think what I'm going to do to kind of soften the Studamus spam that comes in your inbox is post a little bit more to Twitter until the time that there is an official Substack app for the Android platform. And of course, if you have the Twitter app, you can hit that bell notification there and get all my notifications that way. And so you will see more static posts to Twitter and TradingView. I guess you can be notified on TradingView. I'm not sure about the app, but I know for sure you can be notified on via Twitter on the app. So just wanted to give you that update. Okay, let's get into the charts here, and I'll show you what I have been posting, what I have been hinting at. Of course, I've been talking about these items in my videos as well, mainly the disinflationary data that is coming in hot and strong. All right, we've talked about oil, we've talked about gas, we've talked about freight. We've talked about U.S. housing starts, even used car sales, rent, etc., etc. All of these indicators are pointing to disinflation coming soon, actually coming right now. And yet the Fed is in the process of raising rates. Will that change? We're going to talk a little bit about that in this segment. And many of you know that I am of the current persuasion that we could have a market breakout. Specifically, I'm looking at, because this is what I have charted, the S&P 500. And I think it is possible that we create a double top or an M pattern here. And I've alluded to this several times in my past videos, but we are well on our way to seeing this pattern play out. Let me highlight it here real quick for you so you see what I'm talking about. There is the middle of the M, and here we are going up. And I do think we could go at least to our previous high. My target is actually 5,000 before we top out and come back down. And at which point we will start to enter recession territory or a true bear market. Many of you know that I am not of the persuasion we are in a recession or a bear market yet, though in the crypto space that may be true. But the broader markets, not so much. And I'll show you why real quick here as well. Let's go to the SPY, which has more data. And you can see here on the weekly time frame, as I zoom out, we are in definitely a secular bull market. We have been in this secular bull market since March of 2009 and have not, this is our trend line for that secular bull market, we have not ever broken below and stayed below that trend line. Therefore, we are in a secular bull market for almost 13 years now. And some of you guys have been calling this territory up here a recession. No, I don't think that's the case. I think this is still bull territory for sure. Though that could change, and it could change quickly. All right, and you can see, as I have outlined here in the previous chart, the M pattern starting to play out. All right, and that M could definitely take us below that line in the sand and into bear territory or worse. Let's hope that's not the case. What else am I seeing? Well, on a technical side, I am seeing somebody else, and I'm not the greatest for this type of technical indicator, admittedly, an Elliott wave pattern. All right, so you can see here we started this Elliott wave number one in on Christmas Eve of 2018, actually. And this is wave number one, goes to our top here in February 2020, just before the COVID pandemic hit. And that formed wave number two. Hit the bottom there in March of 2020. And some of you who are familiar with the Elliott wave know that wave number three is longer and more extended. And that was in fact the case. We went from 2020 all the way up until January of 22 to form wave number three. Wave number four just came down. We hit our support here just a few weeks ago at the bottom around 3,600 or so. And that is where we started to climb once again. All right, now wave number five is long and extended as well. This is what I would call a blow-off top. And that, I believe, may be coming. Now, I keep talking about disinflation and a blow-off top in the same segment. Here's the idea, guys. What I think may occur here, and I'm going to zoom back into our US 500 daily chart. Let's go ahead and put this on auto and shift on over here where we can see the triangle that I've drawn here, as well as the other formations. The S&P has been right on point in terms of technical analysis, has followed everything to a T. There really have not been too many surprises here from a technical perspective. If you've been following my videos, you can see that we started our hit the top of our triangle there and started our way down. All right, then we hit that 3,900 support area. Once we hit that, we started to form a bear flag and then came all the way down to critical support down here. Number four, that's when the fourth into fifth wave began. All right, as we moved up in, I spotted this head and shoulders pattern on the daily. And look at this, guys. I drew the measurement from the neckline to the top of the head, and that gave us our target down. That is this black line here. You can't see it behind the red candle, but I took that from up here, moved it down. That gave me the target of 3,900. Look at this, guys. We hit this precisely, and this is what I love about technical analysis. When we chartists, when we see this stuff, I mean, it excites us very much. It is very exciting to see technical analysis play out perfectly. And that's what happened in this case. Where's my, there it is. All right, so see, we hit the bottom of the wick downs over here, hit our support, that black ascending line, while the bodies stayed on top of that 3,900 support, which was the precise measurement, the precise target down from this head and shoulders pattern. At which point we bounced, and you'll remember in the last video, I explained that I think where we're going to go before September 13th is right here. This neckline will hit that neckline right at or before September 13th. And look at the US 500, which represents the S&P 500 right here. All right, that is so perfect. Hit the bullseye there, hit the bullseye down here. Look at this. All right, RSI hitting that area of confluence as well. So this is telling us something. Now, with the disinflationary data that I keep alluding to, I do believe that tomorrow's CPI data will reflect that. As the only way it can go is down with all this disinflation data, especially oil. Oil is factored largely into that CPI data and will influence the report that comes out. All right, so we're going to see that down a lot. Though one factor or one element that may not be included in the CPI data is that of rent. Rent is typically about 6 months behind. So we may not see all of the disinflationary data included in the report, but it most definitely has to be down. Now, with that being said, and the Fed, of course, monitoring this closely and assuming, we must assume and we must trust that they have the U.S. economy and the general public's best interest in mind, they would responsibly digest the data is coming in and make future decisions accordingly, right? So that's kind of what I'm expecting. And in that line of thinking, it might mean that the Fed, though nothing may change about the next rate hike. Okay, so let's say they keep it at 75 basis points, which the market has already priced in. Then we just do a little sideways action. But let's say the Fed, after, I got a phone call here, which I can't answer. Let's say the Fed digests that data, continues to be consistent with the aggressive behavior, the hawkish tone towards inflation, and it raises the interest rate 75 basis points, but Jay Powell and company begin to talk or have language, articulate language that is much more dovish into the future. That would all make sense, and it would correlate with another variable that I have not yet discussed. I have in previous videos, but not this one. U.S. midterm elections coming up here in November. Of course, we know the politicians like to have the tailwinds of a strong economy at their back, all right? And so any weakness or in the market, it doesn't typically bode well for those who are currently in charge. And unfortunately, that's just the way it is. Politics and money here in the U.S. are tied together at the hips. They're joined at the hips, and there's no way of separating them at the moment until the general public comes together in consensus and decides to do something about it. That has not been the case thus far. Enough said about that. So that U.S. election will definitely may be a variable that you want to factor into your future price predictions as well. All right. But I do think the Fed is going to see this, and they're going to at the very least, start to speak more dovishly on inflation. J-Pa has been very aggressive, very hawkish in tackling inflation. It really hasn't shown too much of a let up or too many signs of let up. The last one he spoke a little bit more dovishly. There was a lot of interpretation that played into those reports. I think it'll be more clear this time around with this latest CPI data. So that being said, let's see. He keeps the rate at 75 basis points and speaks more dovishly. This is what I am just kind of anticipating might happen. We hit our heads on that neckline, the previous head and shoulders, come back down to a 100-day moving average, and then we come up here and hit the top of our triangle, at which point it will be decision time. All right. That's when we really need the Fed to make statements about what it's going to do with the future rate hike. Will it come down more aggressively, or will the Fed begin speaking more dovishly? That's what will determine whether we can hurdle this line of resistance and break out and form another top on this M pattern that I'm have in place. Okay, quickly, another factor or variable here that I'm seeing is the neckline of this inverse head and shoulders was breached on the euro dollar. Euro dollar is the inverse of, all right, and you guys just lost me on the camera because my battery died. Sorry about that. I'll continue the video and complete it. Is the inverse of the dollar. All right, basically, when the euro dollar goes down, the dollar goes up. When the euro dollar goes up, the US dollar goes down. And right here we have an inverse head and shoulders pattern. So from a technical perspective, it looks like we have breached that neckline and we are headed up here. That would make sense with my M pattern on the US dollar. This is playing out perfectly as well. Everything is correlating, guys. All the data is correlating. Looks like that dollar is coming down. Of course, we've got a couple daily moving averages that will act as support there and potentially keep us at a higher level. We may bounce from there a little bit. Let's say we bounce from that 50-day moving average. That data correlates with what I have drawn here on the US 500. Because when the dollar bounces and goes up, the markets generally go down, all right? So as the US dollar goes up, the S&P goes down, bounces off of that 100-day moving average, and the US dollar will continue in its downward trajectory. All right. And then finally, let's take a quick look at Bitcoin here. I've got a couple minutes left. Once again, right on point. You guys remember from the previous videos, this is where I thought we would be on the 13th. Right here at this big area of confluence, we have the 100-day moving average coming in, 50-day moving average coming in, this great line of resistance, which is now acting as support, fortunately, and this descending line of resistance, which is the top of our longer trending since, let's see, November of last year, descending triangle, which is a bullish triangle. All right. So tomorrow is really going to be a huge day for us. Now, again, if the dollar bounces on that 50-day moving average and goes up, the S&P goes down, of course, Bitcoin is going to go down a little as well. And again, I've said this before, it may actually come all the way down and touch the bottom of this triangle one more time before actually taking off. All right, that's a good way to squeeze out all the longs. At this point, there probably are a lot of longs. I have more data which I could show you regarding longs and shorts, but I failed to have the time. But anyways, I love seeing this, guys. This is beautiful. This in terms of technical analysis, we technical analysis get thrilled when we see this play out exactly as I said this 2 weeks ago that we'd be up here on the 13th, and here we are. So tomorrow is really decision time. Tomorrow is what determines where we go. Guys, that's about all I have. I've got 18 seconds left on this video. And so, Again, if you find this content useful, please help me out and help others out by spreading the word, by liking, by commenting, by subscribing, and hit that bell notification if you're interested in more.